My name is Murad Katan. I'll be the presenter, and my brother Eli is going to be moderating the chat today. So as I said, I'm Murad. I'm the manager at NYC Career Centers, which is an affiliate company of Noble Desktop. Many of you heard about this seminar through Noble Desktop. We're the business school. Let me just mute everyone. Make sure you stay mute. Make sure to stay muted throughout the presentation. At the end, hopefully we'll have some time for Q&A. Please don't record the session. We're going to be recording it. If you want to access the recording, follow Noble Desktop on Facebook, Instagram, or LinkedIn. We're going to announce when each of the seminars are available for recording. We like to edit it first before we distribute. So without further ado, let's jump right into it. Again, everyone should be able to see my Excel file here. You're going to be following along and asking any questions through the chat. So what is a stock? A stock is a piece of ownership of a company. When you own one share of the company or 100 shares, you own 100 out of however many shares there are outstanding. Okay. Now every company has a different amount of shares outstanding. Let me just put the group chat down. My brother's going to moderate that. Every company has a different number of shares outstanding. So if you own Apple, 100 shares of Apple is a way smaller percentage than 100 shares of another company because there are so many more shares of Apple. And just to show you quickly here, you could usually find the share count, or you could find the share count on the first page right here. This is a Form 10Q. This is a company's quarterly report. You can see their total number of shares on the bottom of the first page of that report, okay? This is a company's 10Q, and we're going to touch on this a little bit as we go through. This is where they report their quarterly financial statements. And this says they have 4.375 billion shares outstanding, okay? So if you own one share, you own one share out of over 4 billion total shares. That's a really, really small percentage. So a stock, again, is a piece of ownership of a company. When you're an equity holder, you're entitled to a piece of the profits of the company and a piece of the increase in value as well. So that takes us to why is it valuable? Stocks are valuable because they're pieces of business, and businesses make money and they grow in value over time. What causes companies to grow in value over time? Well, they expand their operations, they generate more profitability, they launch new products. As revenues and profitability go up, the company's value goes up. The other way to make money from a company is just from the profits. Let's say even if they don't increase their profitability or increase their revenues, if they make stable cash flows, you as a shareholder are entitled to those cash flows. Now, it doesn't mean that the company always shares the cash flow. Sometimes they take that money and they reinvest it in the business, okay? Either through mergers and acquisitions, new products, stock buybacks, and so on. Let me just make sure everyone's muted again. Okay, so why do stock values change? Well, stock values change because the expectation for future earnings and future growth changes over time. That's one of the biggest reasons. Stock values change based on the performance of a company and based on what people expect the performance to be over time. Stock values could also change based on market factors like interest rates. When interest rates are lower, that makes stocks more attractive, okay? And I'm gonna have to explain that concept. Let me explain it quite in the simplest way possible. Let's say you have a bond that yields 5% and a stock that has a dividend yield of 5%. You might be like, well, you know, the stock, why would I take a stock at 5% if I could get a bond that pays a guaranteed interest payment? Well, if interest rates fall, now you might be willing to take a lower yield on the stocks, and lower yields mean higher prices. I'm going to discuss that when we discuss bonds. Lower yields mean higher prices. It's a little counterintuitive. So hang on, and I'm going to explain when we do bonds in the next tab what that means. So let's recap. Why do stock values change? It changes because of business fundamentals. Let's say Apple. Is Apple going to sell more iPhones? Are they going to make a higher profit per iPhone? Are they going to expand, you know, and launch new products, right? But they could also change due to other factors, economic factors like interest rates, like unemployment, like the general overall feeling about how the economy is doing. So right now you might say some companies, maybe grocery stores and pharmacies right now during the COVID-19 outbreak, they're doing fine, right? People are still going. Maybe they're even buying up more than usual. They're stockpiling. So why would some of those companies be down if their performance is down? Well, that's because the overall sentiment of the market is very low right now. People are in what we would call a risk-off environment. They don't want to take risks. They don't want to hold equities. Equities fluctuate. Equities or stocks fluctuate in value. And if the economic outlook isn't great, even if that particular company might do well, stock prices typically will fall. It doesn't mean that every stock will fall. Like we see some companies now, like Zoom. Throughout this crisis, Zoom stock has increased, even though the economic outlook has worsened because so many people are subscribing for Zoom, and that's more than enough to counteract it. But if you look across the market, almost every other stock is down. And when I say the market, I'm going to explain what I even mean by the market. Right now, almost every other stock is down because the sentiment is so poor. It's a risk-off environment. The economy is going to have to battle through one of the worst recessions we'll probably ever live through. They're saying, you know, perhaps the worst recession since the Great Depression, even worse than 2008, 2009. So that's one of the biggest things that increase or decrease stock values right there, the economic outlook. Let's jump into one of the most important things that investors look at when determining whether to buy a stock. Well, even before we get into price to earnings ratio, what do you think is the single most important factor in determining whether to buy a stock? Well, the single most important thing will be the outlook for that particular company. What is the industry and what is its competitive positioning within the industry? Everybody knows, you know, Apple is a great company, and Google and Facebook, those are monopolies, Microsoft, monopolies, right? That's why those companies trade at $1 trillion market caps, okay? Now, their stock price is not at 1 trillion, but their value, the value of the company is at 1 trillion. That's something we're going to discuss as well over this 1-hour seminar, okay? Now, the values of those companies are so high because they generate a lot of profitability. They are dominant in their industry, and their industry is generally growing. Social media is ballooning every day. More and more people, more time spent, more and more products are being sold through Apple, more and more Google searches, more subscriptions for Microsoft. Same thing you could say for Netflix, more subscribers. So those companies are worth a lot because the industry is growing and they are dominant within their industry. Now, that doesn't mean that the stock is necessarily a good investment. It does mean that the company should be worth more, but does that mean that the stock is a good investment? We're going to start to look at some ratios and factors that you can look at to determine if the stock is a good investment. There's a difference between saying, is the business a good business and is the stock a good investment? Now, the biggest thing that'll determine that, I think everybody would agree, those companies I mentioned before are great businesses. But we have to look at valuation. Like, yeah, everyone wants to go buy into those businesses. You'd love to be a partner in any of those. And you can be by buying a stock. You become a partner in that company. But the question is, am I overpaying for being a partner or a shareholder, an equity holder in that company? One of the most common ratios you'll see is the price to earnings ratio, P divided by E. PE ratio is short for price to earnings. It's just simply the stock price divided by the earnings per share. Quite simply, if I have a stock that's trading at $100 and its earnings per share are $8, the PE ratio would just be 100 divided by 8, which would be 12.5 times. When I say 12.5, you should think of that as 12.5 with an X at the end of it. It should really format it 12.5X because it's a multiple. That means for every $1 of earnings that the company generates, I'm willing to pay 12.5 times that for the stock. Now you might ask yourself, why would I pay multiple of earnings? I'm gonna have to wait 12.5 years to get my money back? You might be asking, and you know what? That's a pretty fair question. What is the answer? Well, let's back up. When you're a shareholder, how many years of profits are you entitled to as a shareholder of that company? How many years of profits? Think to yourself. Well, the answer is unlimited. If you own a piece of that company, you are entitled to distributions and an ownership stake in that company forever. I mean, unless they go bankrupt and officially close down their doors, you're a shareholder forever. So when you're paying 12 and a half times, that means you get the next 12 and a half years and then some, right? And then into the future, right? Now, the other thing is maybe it's trading at 12 and a half times this year's earnings or last year's earnings. But many companies like, the Google and the Facebooks that I mentioned and Amazon and Netflix, they're growing earnings rapidly. So yeah, maybe you're paying 12 and a half times earnings from last year or this year. But as earnings increase, the multiple is going to actually go down over time. Now, when I even say price to earnings ratio, what year of earnings am I even talking about? I'm just saying earnings. Is it last year? Is it this year? Is it the next 3 months? Is it the next 6 months? Well, first of all, in finance, we look at everything on an annual basis, pretty much, right? When we're looking at these metrics like price to earnings ratio, dividend yields, EV to EBITDA, another metric that we'll discuss if we have time. We're going to look at it on an annual basis, okay? So first, whatever you're using for the earnings, you should use an annual number. Now, are you using last year or next year or 5 years from now? Well, that's the big question. Really, that should be taken on a case-by-case answer, on a case-by-case basis. There's no simple answer to that. But I'm going to show you a tool right now that'll help you determine what the earnings of a company might even be in the future. Well, first of all, to get the past earnings, you could go to a company's financial statements. That's pretty easy. Let's do that now for Apple. And let's look at Apple's latest 10K. The way that I got to this here is I went to bamsec.com. It's a free service with a premium upgrade. It aggregates financial data. You don't need to use a service like BAM SEC. You could go to the sec.gov website and try to track down the financial statements. Or better yet, you could just type in Apple Investor Relations. And on each company's investor relations part of their site, so here you have investor.apple.com, and Google will take you there. They'll give you the latest financial reports and SEC filings. That's the Securities and Exchange Commission. That's the agency, the federal agency that regulates everything related to public companies and public securities, not only stocks, but bonds as well. I like to use BAMSEC because it puts everything in a nice interface. So this is a good tool if you're a financial analyst and you do this as a job. If you just want quick and easy data, you don't want to pay, this is only $35 a month, and you don't want to pay, I don't work for them, I'm not promoting it for them, I just use it. Just go to the investor relations part of a company's site and you'll get the info you need pretty quickly as well. Let's go to Apple's fiscal year 2019. FY stands for fiscal year. And the 10K is an annual report, whereas the 10Q was a quarterly report. I'm going to look at the annual report right now. And I'm going to go to the table of contents. And since I do this very often, I know that item 8 in the 10K takes you to the financial statements. And if I go to the bottom of the financial, if I go to the first statement, what they're calling here the consolidated statement of operations, better known as the income statement, I will see Apple's profit and loss. Well, in Apple's case, it's a very, very large profit, as you would expect. So in the profit and loss statement or the income statement or the consolidated statement of operations, which you could find in the 10K annual report or the 10Q, a quarterly report, I can see the company's total sales. That's the sum of all the iPhones and iPads and services that they sold. I could see their cost of sales. That's a direct cost of producing whatever they sold. Now, it's not only the parts of the iPhone, it's also the labor that goes into manufacturing those iPhones. I can see how much they spent in research and development for new products, how much they spent to sell those products, including marketing and sales reps and stores and all that, selling general and even corporate overhead, the management team and so on. That'll take me, after a couple of lines, you have income taxes here, how much they paid in income tax. That gets you to what we call the bottom line. When people say the bottom line in day-to-day conversation, it comes from financial accounting, which is the bottom line is how much money did you actually make when all was said and done? Well, Apple, for the 12 months ended September 28, 2019, that means the 365 days from there and backwards, they earned $55,000? Well, no. It says here, these numbers are in millions. Okay, you always have to read that. It's in millions. So they made 55,000 million, which is $55 billion in profit. They did $260 billion in sales and $55 billion in profit over the last year. And that equated to roughly $12 of earnings per share. I'm not going to get into the difference between basic and diluted right now, but let's just use basic. They made $12 in profit per share in the last year. So that makes it very easy for us to calculate an EPS multiple based on Apple's stock price. So if I just type in AAPL stock price, AAPL is the ticker for Apple. That's the identifier. Today it's trading at 241.80. Okay, so if I take 241.80, and just for simplicity, I'll use 12. I get a price to earnings ratio. Price is 241.80 and earnings is 12. I get a price to earnings ratio of 20.15. Let's just say 20. That means for every dollar of earnings Apple earned last year, I'm paying 20 times. Now, as I mentioned, it's not always clear. Should I use last year? Should I use the upcoming year? Well, I'm going to show you how to use to quickly derive a price to earnings ratio on next year's earnings. This would be the price to earnings ratio on last year's earnings. And whenever you're showing or communicating a price to earnings ratio, you should communicate what earnings you're using. So if you're making this report for someone else, or you're communicating just with your friends about whether you should buy Apple stock, you should say it trades at 20 times last year's earnings. That's the easy way to say it. That's the vernacular here. It trades at 20 times last year's earnings, okay, or fiscal year 2019 earnings, right? But what you could also do is say, what does it trade on next year's earnings or forward earnings? Well, how do I do that? I turn to my friend Google again, and I type in AAPL earnings estimates. And one of the top links that you're going to get is NASDAQ, okay? The NASDAQ is an exchange, and they provide us with a nice service of aggregating earnings estimates from analysts that cover a company. And if I scroll down here, I can see that analysts are projecting $12.66 per share for the upcoming year ended September 2020. Okay, so I got that by typing into Google AAPL earnings estimates. I find NASDAQ, and I scroll down and I see $12.66 is the consensus. Some people are at the high forecast is 1437. The low is 1088. There's 11 estimates. Over the last 4 weeks, people have revised 7 of those estimates have been revised downward. Now, one thing I want to caution you about here is these analysts have no obligation to update this every day, and they don't. Right now, we're in a time where earnings estimates are going down, but they're not going down fast enough. The analysts are not all updating their models and publishing their estimates on a daily basis. So when you look at these numbers, they could be pretty stale. Now, as it makes sense here, nobody in the last month has increased their estimates for Apple, and only 7 have decreased it. Does that mean that the other 4 are not expecting Apple to revise their earnings lower? Absolutely not. It just means that they haven't published it yet. Apple will earn less money in 2020 than what was previously anticipated. That is a near certainty. There's no way they're going to beat what people thought they were going to do a month ago before this outbreak. So using $12.66, I can just change this here to $12.66. And based on a forward earnings or a 2020 earnings multiple, I'm at 19 times price to earnings. Okay. So when you communicate price to earnings, there's no right or wrong on what you use. You have to take it on a case-by-case basis, and whatever you do, just communicate what you're using, okay? That's what I could say for now is the most important thing, is just being clear on what you're communicating. Let me just check if there's any urgent questions in the chat. Simone, if anyone's asking a question, make sure to publish it to everyone. If you send me a chat, I'm not going to see it because I'm not following it closely, but our moderator, Eli, is following this closely. We had a question, 10Q versus 10K. What I mentioned is a 10Q is a quarterly report, whereas a 10K is an annual report, okay? So over the course of a year, a company will publish a 10Q 3 times and a 10K once. It reports 4 times a year in the US. In Europe, some companies only report twice a year. The $1 million question, how do you determine when it is a good price to buy based off the PE ratio? If the answer were simple, then everybody would make money and everyone would rush to buy the same stock and that opportunity would go away. There's no target like that's a good number. Right now, you could buy airline stocks for 2 to 3 times earnings. American Airlines right now is trading at 2 times earnings. But what earnings are you basing that off of, you might ask? Well, let's take a look at that actually. It's the multi-million-dollar question, and unfortunately, if I could give you that answer, I wouldn't be teaching this course. So let's see. If I do AAL stock price, just based on Yahoo Finance, they're calculating, or the PE ratio is 2.47. I highly recommend that you calculate your PE ratios yourself because these numbers are not always reliable, okay? But let's just assume for a minute it is reliable. American Airlines is trading at 2.5 times earnings. The first issue is, what earnings are they using? Well, they're probably using last year's earnings. And I don't think anybody thinks American Airlines is going to earn as much money they did last year in this upcoming year and maybe even in future years, okay? The other thing price to earnings doesn't account for is, will this company actually be around? You might say, well, 2.5 times earnings. Let's say they get back to where they were and 2.5 years, I'll make my money back. Doesn't exactly work like that, by the way, because they're not passing that through, and I'll discuss dividends in a minute. But yes, I can use Marriott as an example in a minute. 2.5 times, well, is this company actually going to be around for 2.5 years? It doesn't account for the possibility of bankruptcy. Now, when a company goes bankrupt, it might be around in the future. Many companies who have gone bankrupt are still here today, and you might ask yourself, how's that possible? Well, in a bankruptcy, the company could continue to operate and even continue to operate after bankruptcy. But usually in a bankruptcy, the equity holders are wiped out, and the debtors, or the creditors rather, the people who are owed money, are the ones who usually own the company once it comes out of bankruptcy. Now, many companies come out of bankruptcy and don't exist anymore. Like Blockbuster doesn't exist anymore. They liquidate, right? But many reorganize in what's called a Chapter 11. So a PE ratio does not account for the possibility that the company is not around. Now, if you look at Amazon, you might say, well, is Amazon a buy right now? Well, it's 82 times earnings. Oh my God, that's way too much. Well, that doesn't mean Amazon's not a buy, because that's probably based off of last year. And if I take Amazon's growth over the next few years, it might be worth it to pay up now to get that extra growth, okay? Now, another thing I didn't really discuss yet in PE ratios is you're going to want to pay a higher multiple if you believe that company is going to be around for a long time. And not only be around, but they're going to maintain a high level of cash flow for a really long time. Now, if you believe Amazon's going to be around and they're going to grow cash flow and they're going to continue to dominate and expand, you might be willing to pay up right now, and because the growth might compensate for it. Typically, if you buy a building, let's say a Manhattan office building, that's going to come at a higher multiple as well, because the cash flows typically from office building in primary markets are very stable. The more the stability, the higher the multiple. The higher the growth, the higher the multiple. The more risk, the more chance of liquidity issues and potential bankruptcy and declining cash flows. The more volatility in the company's cash flows. The higher amount of leverage, meaning debt, that the company has relative to its cash flows, the lower multiple. American Airlines right now is a poster child for a low price to earning because it has uncertainty of cash flows, high leverage, potential for bankruptcy. Somebody asked to look at Marriott. Marriott is trading at 15 times earnings right now. Again, you can't really trust these earnings. I don't know if this is last year's earnings, next year. I don't know which analyst they're using, okay? But 15 times right now, I mean, it feels a little bit high. But again, I can't really trust these numbers right now. I'd have to do a lot more research on that. Let's see if there's any. Okay, so let's move off of PE ratios onto dividend yields. One of the things I mentioned is a company doesn't have to pay out all its money to shareholders, right? Companies typically generate profits, right? Stable companies that have been around for a while typically generate steady cash flows. Newer companies, even like an Uber, might not generate profitability, so they don't have anything to pay out. But let's take a company like a Clorox. Somebody asked which companies sell essentials. Like a company like Clorox sells essentials that we would need in these times. Those companies have been around. Walmart, they've been around. They pay dividends. What is a dividend? They take a piece of what the company earned and they give that to shareholders, okay? Now, let's calculate a very simple metric, a dividend yield. If a stock price is $100 and a company pays a $1 quarterly dividend, what is the annual dividend yield? Well, first I have to say, what is the annual dividend? Well, if they pay $1 quarterly, which is the way dividends are typically paid, I multiply that by 4 and I get $4. My dividend yield is equal to the dividends paid over the course of a year divided by the stock price. 0.04, I'll turn that into a percent. And my dividend yield is 4%. That's what a dividend yield is. It's just how much cash are you getting back on an annual basis in the form of dividends as a percentage of the stock price. Okay. Now, dividend yields in itself do not inform whether a stock is a good investment. I could show you a company right now that's trading at an 80% dividend yield. Does that mean you should buy it? No. The first reason a high dividend yield might not be a reason to buy a company is because that dividend might not be sustainable. Just because a company paid out a dividend last quarter doesn't mean it's going to continue to do so. Investors want the certainty. Companies are not obligated to pay that dividend. They could cut it at any time. As opposed to an interest payment on a bond, a company must pay that, and if they don't, they would be in default. A dividend is not a contractual requirement as opposed to an interest payment, which is. Another reason is it doesn't account for the risk in the company. Some companies have more volatility in cash flows, right? So a company might have a high dividend yield now. Again, their dividend yield might go down over time as maybe they don't earn as much. Okay, so kind of the same idea that I was saying before. There's another reason that dividend yields don't inform whether you should invest in a company, and that's the dividend payout concept. Just because a company's paying out, let's say, $4 a year, doesn't mean that it couldn't be paying out more, okay? Apple, let's take this example. I don't know if this is exactly right. Well, Apple, let's use actual numbers. Apple earned we saw $12 per share last year, okay? And I'm going to go and find Apple's dividend just by typing AAPL stock price. And I'm going to see, let's type in AAPL dividend. And let's see what Apple's dividend history is. Based on the last 4 dividends, there were 77 cents, right? 77 cents. So in the last year, it paid 0.77 times 4. That's $3.08. These numbers are going to work out very nice for us. If they paid out in the last year $3, but they earned 12, that means they only paid out 25% of their earnings as dividends. That's a 25% dividend payout ratio. In reality, Apple, it's not exact math, by the way, what I'm about to say, but you could think about it as they really could have afforded to pay $12. They only paid $3, so they only paid out 25%. It's not exactly right, and to learn how EPS and cash flow are different, you should take our financial accounting course. That's a whole separate branch to understand, but just for simplicity, you could assume that Apple could have paid out 12, but they only paid out $3 or 25%. So in the case of Apple, it's not paying out its entire dividend. So for Apple, you're willing to take a lower dividend, partly because they could afford to pay out more, but they're just not doing it. So their dividend yields 1.28%, but their payout ratio is only 20% based on the way they're calculating it here. I'm not sure, again, what earnings number they're using. I'm using last year's earnings. For their payout ratio, they might be using forward earnings or next year's earnings, and they're not specifying it here, which is not best practice. So so the question you're probably asking is, what do companies do with that cash they're not spending? They're not paying out as dividends. There's a whole $9 per share that Apple's not giving to shareholders. Well, one thing the company could do is buy back its own stock. Actually, before we get to that, the most common things they could do. They could go buy other companies to grow their business. They could be opening new stores, which are very capital intensive. The build outs are expensive. They could launch new product lines. Just put a lot of money back into the business, buy other businesses, buy other technology, so on and so forth, right? But another thing they could do is buy back their own shares, meaning when I showed you earlier that Apple had 4 billion shares outstanding, they could actually go into the market and buy back their own shares and reduce the share count. Now, why would you want to reduce the share count? Well, you reduce the share count because if there's fewer shares, then everybody owns a bigger piece of the pie, and shareholders are happy because they now own a bigger percentage of the company. And when you own a bigger percentage of the company, you also own a bigger percentage of the earnings. So your earnings per share, all things being equal, would go up because you now own a bigger percentage. The denominator in the earnings per share, which is earnings divided by shares, the denominator is lower, which means that the total is higher if you divide by a lower number. So shareholders are happy because they now own a bigger piece of the pie. They get more of the earnings and they're loving it. That's what stock buybacks are. Now, I want to see if anyone could put in the chat, why do stocks not automatically go up? I just told you these amazing things about stock buybacks. Wow, you could own a bigger piece and you get more of the share of earnings. Who doesn't want to have more, right? A bigger percentage. Why don't stocks automatically go up when companies buy back their shares? What are they, in essence, losing, or are they really losing nothing? Let me see if anybody could get this answer. What are they losing? Let's see if anybody. Someone asked me in the meantime, where can you see a company's cash flow? It is public info. You go to the 10K or 10Q and you have to read through the financial statements. We have a whole separate course just on financial accounting that goes through that. I'm giving you the very, very basics right now of how to find that info. But financial accounting, we could spend a week on it, but we do have a one-day course just on financial accounting, and we'll share the links later. Could anybody tell me why a company's stock price does not automatically go up if they buy back shares. Is it free lunch? Okay, I'm not getting the right answer from anyone here. The answer is that it's not a free lunch. They have, oh, someone finally got it. They spent money for it. That's the answer. If you buy back shares, what are you losing? You're losing cash. So yes, everybody owns a bigger piece of the company, but that company that they now own a bigger piece of now has less cash, and cash is valuable. That's the answer. So I like to bring that up as a question because there's always headlines, wow, companies buying back shares and earnings per share are going up. But that's one thing to realize, by the way. When companies buy back shares, their earnings don't go up. It's their earnings per share. And yes, oh, my wife actually just chimed in and she said less cash to put back into the company. That is correct. They have less cash. Thank you. This is extremely important to understand because you see stock buybacks in the news every single day. And now that companies are strapped for cash in this crisis, all the regulators and investors are being like, you guys spend all this money on stock buybacks and now, now you're almost going bankrupt. Everyone's pissed that they use this money to buy back shares instead of reducing debt. That's another thing you could do with your cash. You could reduce debt, which puts you in a better financial position to weather a crisis like what we're in right now. Let's move off of one or two more items related to stocks. The ex-dividend date is the date that on that date, if you buy the stock, you don't get the dividend. So for example, let's say a company goes ex-dividend tomorrow, okay? And I buy the share today, but the ex-dividend date's tomorrow. If I buy the share today and the ex-dividend date is tomorrow, I get the dividend. But if somebody else buys that share, that same stock tomorrow on the ex-dividend date, they don't get the dividend. That's the question of who gets the dividend, right? Well, you get the dividend if you own the stock before the ex-dividend date. If you wait till the ex-dividend date, you don't get the dividend. So because of this concept of no arbitrage, you might say, well, wouldn't it be a great idea if I go out and I buy a stock right before it pays a dividend? So this way I get the dividend and then I sell it, right? So this way I got the dividend, but then I sell it for the same price. Well, there's a concept in stock market investing of no arbitrage, okay? Which means that there's no quick and easy way to make money in doing things like that. What happens when a company pays a dividend and it goes what we call ex-dividend? The stock price should go down by the amount of the dividend. Now, it doesn't go down exactly by it because there's a lot of other factors on that particular day, but the stock price should reflect that a dividend of that amount was paid out and the price should be adjusted accordingly. So if you buy a stock before the ex-dividend date and you get the dividend, the next day when you go to sell it, the stock price will be lower by that amount, but again, it might be a little bit higher or even lower than that based on other fluctuations. It's not going to be a cent by cent exactly, okay? What is an IPO? An IPO is the first time a company offers its shares to the public, okay? Companies start off as private companies. To buy shares in those, you have to negotiate it with whoever owns the company, okay? This company, NYC Career Centers and Noble Desktop, our training companies, are not public companies. You can't go on an exchange and buy stocks and see the stock price on a day-to-day basis. A company like Amazon, Facebook, those are public companies. You can buy their shares easily on an exchange. You just put in your order and let the technology take over and you'll buy a share. It's really easy, okay? Now, before a company IPOs, they're typically owned by venture capital companies, or venture capitalists own a big part of the company. That's actually, let me backtrack. Why do companies even IPO? Why do they go through the headache of all this? Well, what an IPO does is companies buy shares from the company, and that money goes to the company, and the company uses that to grow or to fund operating losses while it grows. Okay, so Uber IPO'd because it needed money to expand into other countries, and it was losing money, right? So it needed capital. That's why companies IPO. Now, when you buy shares in an IPO, that's the first time Well, okay, let me say it like this. When you buy shares in an IPO, you're buying it directly from the company, okay? When you buy stocks on a day-to-day basis now of any of the stocks I mentioned or any stock in the S&P 500, any other publicly traded company, you're not buying it from the company. You're buying it from someone else who's selling it, okay? But when you buy shares in an IPO, that money almost always, but not guaranteed, goes to the company. Okay, sometimes you have individual stockholders that are selling their shares in an IPO. But most of the times, your money goes to the company to fund their business plan. Okay, now an IPO is the first time a company offers shares to the public. It could do it again in a secondary offering, but the IPO is just the first time it does it. So this whole idea, when people say finance, what are they talking about even in finance? What they're talking about is how companies get money to do what they need to do, to pay back debt, to fund their operations, to expand their operations, to fund an acquisition. That's what finance means. And one of the biggest ways of doing that is going public. I say that in quotes. Going public is the process of IPOing, okay? Now, finance, even bigger. What is a bigger way that companies get money? Okay, to finance their operations? Throw it up in the chat. What is the other major way, even bigger than issuing stock or selling equity? Yep, Shaquille said debt. Companies raise debt. They could do that through a bond offering. They could borrow money directly from banks. And we all know the type of financing that we would get. If we're a small business, you could go directly to a bank. If you're borrowing against a home, you could take out a mortgage. Debt is the main way that people get money. Debt is omnipresent, okay? It's literally everywhere. Credit card is a form of financing, okay? A mortgage is helping you pay your home, but helping you purchase a home, and so on and so forth. Companies rely mostly on debt to finance their operations. The debt market is bigger than the equity market, okay? Now, not only companies rely on debt while I'm talking about this, governments, municipalities, pretty much everyone and everything that spends money relies on debt to finance their operations. The United States government has a $22 trillion debt balance right now. Okay, so they borrow a lot of money. I think you could just do national debt, US national debt, and you'll get the number. Like, it's on a bunch of places, like I think in Times Square, they have the number floating around somewhere also. But obviously our friend Google will have it. So again, an IPO is a way that companies raise capital to finance their operations, and they don't have to pay that money back, okay? That's the benefit of equity financing. That money never has to be repaid, but those people own a part of the company. They're giving up a piece of the company, but it doesn't have to be repaid. Let me just give a minute for everyone to ask any questions you might have and for me to do a quick time check. Okay, great. Let's discuss a few more concepts of stock market investing before we go into bonds, and we'll end today with the bond section. Okay. Now, as you can see here, I have many tabs. I'm basically drawing here from our longer stock market investing course, which is a 6-hour course. For today, we're going to cover the stocks and bonds part of it. Hang on, I'm just checking the chat again. Okay, great. Efficient market hypothesis basically says that all news is priced into a stock, that the information is efficient. So if you think you have a secret about a company, well, first of all, it might be insider trading, but if it's not insider trading, efficient markets hypothesis says it's already priced into the stock. Everybody knows that COVID-19 is going to impact this company this way. And everyone knows that, you know, the company's new model is going to be great, or that their expansion is going to yield money, or Amazon's going to take over. That's the concept of efficient markets hypothesis, meaning that all information is priced in to a stock already, and it's known. Now, inside information is another thing. If you speak to the CFO of a company, he says, hey, we're going to report earnings and it's going to be better than people expect. Well, that would be inside information. If you trade on that, you risk prison time and fines, okay? Expectations theory says basically that stock prices move based on changes to expectations. So you might say, okay, Apple reports earnings and it announces $15 billion of profit. You might say, wow, that's an amazing quarter, 15 billion. Well, if the market was expecting 16 billion and they only reported 15 billion in profit, the stock's going to go down. That's the concept of expectations theory, that stock prices move based on variances to expectations, okay? And in a way that traces itself to efficient markets hypothesis, in that if everything's priced in already, then things should only move, stock prices should only move if there's a variance in what people expect or in what they know, okay? That's why when you look at stock prices after earnings, sometimes you say, wow, this company, earnings went down, but the stock is up. Or they announced this and that, and it seems like bad news, but it's up, or it's good news and it's down. Well, it depends on what people were expecting. And what people were expecting was priced in, and then if that expectation changes, the price will move, okay? Concept of no arbitrage is very similar to what I discussed before with the dividends. Concept that you can't make a guaranteed profit. You can take risk and you'll make money, but it doesn't mean it's a guaranteed profit. Now, one thing I want to discuss is why stock prices generally go up over time. Well, they go up over time because companies generate cash flow, they grow their businesses, and if you invest in a diversified index of great companies like the S&P 500, which has 500 of the greatest companies based in the US, over time, that's going to go up, okay? Does it mean it's going to be higher in a week, a year, 5 years, maybe even 10? No. Over the long run, yes, they make money, they grow, and so on and so forth, okay? And don't take that from me, take that from Warren Buffett. Does that mean if you're investing in the stock market, you're arbitraging? No, an arbitrage is a guaranteed profit. By still investing in the stock market, you're expected to make money, but it's not like you're buying, you're trading $1 for 21 nickels. That's an arbitrage. If someone comes to you and say, here, I'll give you these 21 nickels and you give me $1, that's an arbitrage. Buying a stock and then collecting the dividend and knowing that the stock price is going to be the same the next day and collecting that dividend, that's an arbitrage, right? Another example that I like to bring up when talking about arbitrage is interest rates. In the US, the last couple of years on average, the interest rate for US treasuries was about 2%. In Europe, it was about 0%. Now, you might ask yourself, why don't Europeans take their money and buy US treasuries, right? And guarantee that they're going to make more than they would have if they invested in the European market. That seems like an arbitrage opportunity because what they could basically do is go buy US treasuries or US government debt and short or sell European Union bonds, whether it's the German Bund or similar security. They can make themselves a guaranteed profit by doing that. Could anyone figure out why that's not a guaranteed profit? It would seem like an arbitrage. The interest rates in different countries are different. So why not take my money in the US, right, and go invest it in India where the interest rates are 5%. Here, we're only getting 2%. Could anyone tell me why why that opportunity seems to exist? And is it an arbitrage? I told you no arbitrage, but I'm telling you right now that you could go take your money and invest in higher yields in other places. I actually lost my chat here. Hang on. Okay, the answer is going to be, it has to do with foreign exchange, okay? But what I'm saying is it's foreign exchange, but it's a little bit nuanced here. You could change your money into the other currency. However, it's expected that, let's say you take your US dollars and you convert it, you buy Indian bonds, right? It's expected that the value of the rupiah, I'm not sure if I'm pronouncing that right, in a year will be lower, okay? The currency is expected to decline in value or increase in value relative to another currency, Okay. So today the dollar trades at whatever. Let's say it's 1 point. Let me not get into specific examples actually. Let's say the dollar trades at one level relative to another currency and you say, let me get rid of these dollars. Let me go exchange it into another currency, buy those bonds. What's going to end up happening is, you might make more on the interest rate from that other currency. Let's say a third world emerging market, let's say. But the market is expecting that the currency will decline and your profits will be diminished. Now, does it mean that you might not make a profit? No, you still might make a profit, but there's no way to lock in the profit. When you lock in the profit, that's an arbitrage. But if you're still taking risks, like, you might make money, but it's not guaranteed, that's not an arbitrage. Okay, that's the concept of no arbitrage. Next, shorting a stock. You can bet that a stock price will decline. And I highly recommend that you don't do that unless you're a very sophisticated investor with a high threshold for pain. If you bet that, let's say a stock's trading at $100 and you bet that it's going to decline. If it goes to 100, you lost 100% of your money. It could go to 300, 500. You could lose more than you bet. That's really bad. If you buy a stock, you can only lose what you put in. Okay? Can't lose more than that. But if you short a stock, your downside is unlimited. If you short it at $100 and it goes to 500, you're losing 400. You only put in 100 originally. Okay? So how do you actually short a stock? Well, first you just go to your brokerage and you could just click sell short and they'll do it for you. But what actually happens when you're shorting? When you're shorting a stock, essentially what you're doing behind the scenes, and again, you're not actually doing this, your brokerage account is, you're going to borrow the shares from someone. You're going to say, let me borrow I don't think Tesla is going to go up. Let me borrow your Tesla shares. And what do you do once you borrow it? You go sell it and you get the money. So Tesla's at 600. You sell it and you have $600 now in cash. But what do you owe? You owe the Tesla shares. Now you say, let's say things are going great for you and Tesla goes down to 300. Well, you owe the Tesla shares. You owe Tesla shares. So what do? You go back and you buy Tesla shares back for 300 and you return it to the original owner. And again, the brokerage account's doing this all for you. You made a profit because you sold it at 600 and you bought it back for 300. But the opposite might happen. You might buy it, you might sell it at 600, but when you go to buy it back and you're like, oh my God, I'm losing so much money. I gotta get out of this position. Well, how do you get out of a short position? You have to go buy back the shares. And if those shares are higher, you're going to lose money and you could potentially lose a lot of money. Now, shorting stocks over time does not on average make money because stocks on average will go up over time. Now, again, it doesn't mean that you can't make money shorting stocks, but it's extremely difficult over a long period of time because you're basically fighting gravity. As I've said, stocks are priced to go up over time. We don't know over the next week, month, 5 years, or 10 years, but over a long period of time, if you're thinking about your 401k, 40 years down the road, stock prices will be higher. Is it going to generate a 5% annualized return, a 3%, an 8%? Nobody knows, okay? Nobody knows for sure. But most people expect that over the long haul, stocks will return, the S&P 500 will return about 7% on an annualized basis. But nobody knows for sure. That's shorting a stock. Liquidity and trading volume. Liquidity measures how easy or how much, let's start with trading volume. Trading volume tells you how many shares were traded on a given day. If you want to buy $1 million of Apple, you could do that very easily because there's so many shares being traded. It has high liquidity. But if you want to go buy shares of penny stocks like they did on Wolf of Wall Street, you won't be able to buy a lot, and there's high fees associated with doing that because there's very limited liquidity. You have to be very careful when buying stocks with low liquidity because you might end up paying high fees in the form of bid-ask spreads. Bid-ask spreads is basically how far buyers and sellers are apart, okay? Just because you want to buy at 100 doesn't mean that someone's willing to sell at 100. So somebody just asked, what type of stocks do you suggest investing in the current market? I'll get to that in a second. And we have 5 minutes. I'm not going to get to bonds, but but we have a couple of resources for people to look at. I'll wrap up with the liquidity and trading volume and that question. So you want to be very careful that you're buying stocks with a good amount of liquidity and not buying fraudulent penny stocks, okay? People underestimate that, and that's an easy way to lose a lot of money fast, is buying things that are illiquid, okay? Illiquid means not easy to buy and sell. When you look at stocks, by the way, one of the good things about investing in stocks is, in general, the liquidity is very high, meaning if you want to sell it, you could go sell it. Let's say right now you needed to drum up some cash and you're like, I need to get out of my stocks because I need money. You know, I lost my job, right? You could do that right away. But if you, someone's saying that's right, it happened to me. If you want to go sell your home, or you have a real estate investment and you need the money, it's illiquid. It's not going to be able to be sold that quickly. And if you did want to sell it quickly, you might have to slash the price pretty hard to get it done, okay? So stocks in general, what makes stocks a drop more attractive is the general liquidity, okay? It's something to consider when making any investment. How quickly can you get your money back if you need it? How easy is it to buy more and to sell it when you need to? So somebody asked, we're going to wrap up in a couple here. Somebody asked, hang on, I'm looking for, let's just back up in general here. So to come up with a good stock investment, there are many factors you have to look at, okay? People asking, is now a good time to invest money? There's a variety of factors you have to look at. You have to look at the specific stocks and the fundamentals. By doing what we did over a few minutes, just in a few minutes, you need to spend a lot of time, but I only showed you a few minutes rather. Looking at the financial statements, reading financial reports, reading earnings transcripts, company presentations, analyst reports, research reports on the industry. You need to understand the company, their competitive positioning within the industry and the industry. You need to understand the economy. You need to understand valuations. Right now, we're in a very odd time. Nobody really knows what to expect. So a lot of the fundamentals are going secondary to what's going to happen with this outbreak. How long is it going to last? Now, someone's asking, is now a good time to invest money? If you invest money now, there is a high chance that you lose money over the next couple weeks. The stock market right now is very volatile. But if you have a long-term perspective, hang on, I'm getting more questions. If you have a long-term perspective on stocks, over the long term, you're probably going to make money, and it could be a good idea to start getting something in to the market. However, if you're the type of person who puts money into a 401k and starts putting in some of their money, and all of a sudden you look and you put in 10 grand, and 2 weeks later or a month later it's at 8,500, and you're the type of person that would panic, then buying stocks might not be the right thing for you. If you're gonna buy stocks, you need to be able to ride out the ups and downs. Over time, you'll generate a return, but what that return is going to be and how much you'll generate is not certain. We have paid classes that are live online on nobledesktop.com and training-nyc.com. We have Excel, data analytics, Photoshop, pretty much anything you want to learn if you want to skill up in professional. So we have a wide variety right now of free stuff and paid stuff, something that everyone could do to make their time productive. I hope that everyone today had a good experience here, picked up a few fundamentals. The recording will be online. I know we covered a lot in a short amount of time. There really is a lot that we could continue to cover, so I hope to see people back. Stay safe.